Hello, everybody. Bryan here. Happy July 4th for US viewers that might see this today. July 4th it is. Okay, let's talk about stock market math. This is kind of moving into quantitative trading research techniques. This is where you start. This is found on quantinsti.com under their blog. Title is Stock Market Math Essential Concepts for Algorithmic Trading. Anyways, I'm not going to go into this article in detail, but what I'll do is I'll go through each one that I may know and not know, um, and I'll talk about it. Okay, so the first area you kind of want to know is the measure of central tendency here. So these are descriptive statistics. You can go to this article I'll put up. This is usually pretty standard for measuring price moves and pretty well anything. So here we've got the measure of central tendency. And you can see here we have the mean, which is kind of like an average. And then we have the median, which is the midpoint between the low and the high point right here. Uh, so that's the big difference there. Yeah, middle value. Okay, so that's kind of important to know the difference between that and the mean as well. Okay, so we've got mode. I'm not sure if that means a whole lot. The one that I know that's pretty standard are these two, variance and standard deviation. These other three, I'm not going to get into a whole lot because I don't really put a lot of attention to them. Variance is basically, um, yeah, dispersion over a data set, which is really your price uh, movement over a period of time. The farther it moves away, you can consider that more volatility. And maybe it depends on really what goes on. Like if you saw some of the charts that I posted today for my members over at the quantlabsnet.com, you'll notice that certain Forex pairs have spiked and they go into this really severe parabolic move. So that sort of variance will spike, and it's very hard to measure that because of, let's call it, we'll just call it volatile moves, and it just goes back to mean reverting. Uh, and that really, when I say mean reverting versus trend following or momentum based, there's two ideas there. There's two types of strategies that most people will probably know about. The first one is mean reverting. So when I say we have a high variance and then it drops back to its mean, what we're talking about is that the price will continue on its path base built around its past mean over, again, a certain period of time. For me, I don't like it. Again, it depends on your risk profile. If you're in your 20s and 30s, you could probably take uh, those type of assets, be it stock or ETF. This could be pretty well set for anything. You can probably lump those into an overall portfolio because you are willing to take the aggression on those price moves and the high volatility of those price moves. Um, and you have the threshold to put up with that in your portfolio. Now, if there's a major drawdown where your overall your portfolio takes a major hit, you still have time to recover from that. When it comes to low volatile, that's what I only look for. It just makes you sleep easier at night. And there's standard trend following strategies that I use, like an Ichimoku cloud, because that's kind of important to understand. Okay, so I've gone way off as usual. Um, the other one that's important here is standard deviation. Let me just close this. So mathematically, I'm not going to explain standard deviation, but basically standard deviation is, like how far off are you moving from the median or from the mean on a price over a certain period of time. With standard deviation, generally there's a standard tolerance of 1%, or sorry, a standard deviation of 1, which is considered normal. If you have a standard deviation of 2, that's something to be kind of concerned about. This is both on the upside and the downside. So if you have a standard deviation of more than 3, that's considered pretty extreme. So those are sort of moves you'd want to be careful of, even on the upside, because as I said, there's generally a spike there. And even if you look at, let's say, a stock that just jumps up because of a good stock report, quarterly report, the stock moves, and then generally there's no standard trend from there because it just goes back to its flat movement. I could probably look at Apple like that as an example. Let me just pull up, that'd be probably a good way to go. So let me just show you an Apple move here as an example. You can see here, generally, we are on a, let me pull up the daily. Now, this is another big thing that matters. But when it comes to standard deviation here, you could see here that big spike came along through this period. Now, what's driving that? Is it a stock performance of Apple itself because of some good fundamental news coming out of Apple or some new product they're developing? Who knows? But you can see here originally it did drift back, but all of a sudden it started to move up again. Generally, with that is tied back to the general performance of the overall stock market, namely in the Nasdaq. So these are the sort of things you need to understand to really fully appreciate things like standard deviation because um, the lower the standard deviation, what I'm finding is the drawdowns when something happens, those stocks with a lower standard deviation, but that's within the normal parameter of 1, usually are okay on the downside. So they're going to be, from what I see, less volatile. Now, again, I can always be wrong. I'm always interested to hear in your comments on this. I do learn from it as well, and appreciate people may have. All right, so let me just get rid of this. Yeah, okay. So back to standard deviation. So here we've got our visualization on the different charts of you can see here all I'm using is just a standard, call it a line chart of the price, pie chart, all that, histogram. I'm not sure if that really means a lot because uh, what happens there is you could easily get lost in any of these other types of charts here. So the line chart, I'm assuming it's related around price. Let's see here, line chart. Is it working? Yes, no. Okay, so there's our okay, so this can matter actually. Okay, when it comes to the histogram and you want to know about your tail events on your distribution on the prices themselves over a period of time, this is a standard distribution chart. So out here you can get some tail risk negative on the left tail risk, which is both extreme. If you're on this side and you get lucky on a big price move, as I said earlier, with Apple as an example, where you get a big stock uh, annual report, quarterly report that drives the price up, that could be considered a tail risk. But generally, you don't want to have things that are really too wide apart because it just shows the volatility in the price. So that there is some validity there. Bar chart, I don't know. I don't really use it. Uh, Pie chart, maybe if you're looking at the holdings of a ETF to see what stocks are being held in a particular ETF, and you may have some ETFs that are in the same sector that are performing. And when you go through all those holdings of those performing ETFs in that same sector, generally you'll find a trend of the stocks to hold. So let's say, as an example, if you go through all the tech stocks for an ETF performer, um, you'll notice that there's going to be your usual Microsoft, uh, Apple, maybe, and other performers throughout those ETFs. That may be useful. I don't know. Anyways, here's a line chart I was saying about the price. So that can be useful as well. Now, this is important stuff here that probably not a lot of people talk about. Monte Carlo simulations just running back tests against a trading idea, which is fine. And that's what's one of the big drivers of AI. Back in the day with NVIDIA, when they brought out their cards for which would before the NVIDIA, they were GPU cards. So that started with crypto mining. It also was kind of still popular among a lot of the algo trading HFT shops to use those cards for which was remember it's originally graphical processing unit, originally used for graphic processing, but because the language and the framework that NVIDIA built, you can still use those boards to speed up the Monte Carlo simulation. And then out of that came the AI uh, application that really made NVIDIA what it is today. And that happened maybe in the last 2 years. So Monte Carlo is very intense from a computing point of view to run it. If you're even doing it in a spreadsheet, one place to do it, and I've mentioned this before, is in MATLAB because it's like not very many lines to set that up. 5 lines. You run it. You can also run it on their cloud environment, and it's all running on some kind of GPU board because even MATLAB have a list of boards that are compatible with MATLAB, and it's all done in the background. So that's the big disadvantage of Monte Carlo. And if you're paying that through a cloud provider, you're going to probably pay some big money for that testing. Now, the next one's a random walk. A good one to look at with a random walk is right here. So between July 5th to here, some would say that this is a random walk. Some would say this is a sideways move, okay, or it's flatlined, okay. So that's all fine and good, but when you look at Bitcoin, Bitcoin's a great example of that because you can see here back in October 23, it moved uh from was that that's the volume, I guess, but it moved up to about 60, $70,000, right? Oh, that's a market cap. Yeah, here. I'll pull up the right one. US dollar with price. That one should work. Okay, so you can see here the price was at 26,000, driven up all the way to 71,000. But when you go further back, um, you can see here when it was driven up back in the peak here of 2021 November, it dropped pretty well to its baseline just like 2 years prior. It did bounce around and drove up quite a bit and it dropped back. These are standard extreme moves, very volatile asset to have in your portfolio. And then here in this period, you can go from, let's say, May 22 to in around here to April 23. So if you had money put here um, and you invested into Bitcoin and holding Bitcoin, that would this period right here would be the crypto winter, Bitcoin winter. And it's just another way of saying a random walk because there's no sense of direction here. So what's driving up the price of Bitcoin from this point here in, let's say, January 2023 and eventually in October 2023? It's all fundamentals. Maybe something else happened in another asset class, and then Bitcoin became the go-to um, investment to hold because there's no performance elsewhere and Bitcoin performs. So that is one of the fundamental drivers that will drive up that price. And then we go into this random walk again since the peak here of March 2024, and it goes into this random walk. So the random walk, a lot of people say does not exist. I believe it exists. But that's generally when things flatline and there's just no sense of direction. Once you have an asset that hits um, that asset that random walk period, I'd be probably looking at other assets. So for instance, if I go back let's say 3 months since Bitcoin's gone into its random walk, and I compare it to something like oil as an example. Okay, let me just pull up BCO. So That could be, I'll just put under PCO USD. Okay, so this is Brent crude oil. So you can see what's happening now is that right now oil is starting to move up compared to Bitcoin going in a severe drop. So right here, this is since June 24th and last week. If you knew about this, you would take your money out of Bitcoin and move it into oil. Because why? Because if you have capital in your portfolio here, uh, you're losing out on an opportunity cost to oil because it's starting to perform now. This is why it's important to watch your own portfolio and be able to do what I'm doing. And if you don't have a full-time job, because it does take time, hey, that's what I do. You can join my services for that at quantlabsnet.com for that. You can see here you would have lost quite a bit, 8% in the last little while. But so if I did a 5-day view as an example, you'd be up 2% versus with oil versus Bitcoin. So those sort of things are important to understand. And when you look at, let's say, another very extreme example is, let's say, if you look at the SPX or the SPY, okay, and you go back, I don't know, this now we're going to go back 5 years. Um, you can see here, this is the important part here. In 2021, everyone's going to have their money in the SPY or the general market indices, the major ones. You can see here is a decline. What happens to oil? It moves up and it performs better. Problem is that you've got to be able to watch this. And same with here with the SPX or a SPY is finally outperforming oil. So all along here, it goes into that random walk. And these are important things to know to really, as Buffett would say, to not lose money, which is number one. And number two, repeat number one. And number three is to make money. So here, what we're talking about is we're going to make money if we're watching this carefully. I can also guarantee your professional financial advisor will not be watching this. They'll just put money into a bunch of ETFs and stock and hope everything works out when the general US markets move up, like SP, like the SP 500 or NASDAQ. And doing that might not be wise because you start to lose money in this of like 2021, 2022 when the markets went down. Now, statistically, when you look at here, you lost money. Now, again, if you had money maybe going into something else, you would have retained your wealth during this period. Luckily, it did come back. And generally, what I'm finding right now with the way the economy is, the way the numbers are showing, the fundamental numbers, next crash, it may not recover. And if it did, it might take not 1 or 2 years to recover, but could take 10 years. Now, again, if you're my profile, high risk, or where you got to be more, we'll call it conservative, you don't have the luxury to wait around sitting in thinking that the performance of the markets or the US markets will continue to drive up all the time. That's not the case. Another good example of that is real estate. So you want to make sure you're not going into that random walk. Regardless of what you hear, what you read, what you watch, you'll get different opinions on that. Now, when you get into the linear algebra stuff, this is where it gets kind of wonky. I say that because this is where you're going to go into the low level, real quant, low level, whack in the weeds kind of quant stuff and math analysis. This is where your math PhDs will live in all of these. Okay. So we're dealing with calculus here, linear algebra here. I don't get into that. Usually the price will be baked in for that. But if you have the time and the smarts to do it, and you're looking using those techniques in the options market, you will be better served because then you can see and project the down moves coming in the major options market, which lead into and impact the rest of the markets being equity, maybe even futures, and the fundamental called Main Street as well. So seeing that, being able to predict that will save you if you are willing to put the time into it. And all the other languages I talk about, Python, C++, can do all that. Linear regression is another important aspect. There's the days before machine learning, and there's the days with current machine learning uh, and moving forward with machine learning. So linear algebra, let me just see if I can see an example here. So another thing that they don't talk about here, which I think is important, and it's fairly easy to see, this is a great example with SPY. So if I just put a standard indicator in here called the trend line, okay, let's try this auto trend line here. So you can see here, um, generally the auto trend line saying, yes, we have a green trend following, and that's all fine. I think we need something a little more intelligent than that. Let's see, trend line, but we'll pick a popular one here. Yeah, Lux Algo on TradingView is quite good actually. So here you can see the trend lines for the last, let's go year to date. So you can see here the trend lines showing you the general trend, and what people are not realizing, this is actually a good one. Here is a good entry right here. And this is on a daily basis. So this entry right here is good because you can see the solid trend, and that's that break right here in green. And then here, some may consider this as a point of exit as well. Here, these are the low points on the trend, and it's also giving you the entries as well. It doesn't give you the exits. It looks like it does give you the exits here as well. This is just one of many examples you can get on TradingView. These are all free as well, I might add. So the trend is generally pretty good for that. Okay, let's get rid of that. And that leads us into regression. So regression can be somewhat used uh, along with the trend. But here you can see a general regression. This is similar to like a Bollinger Band, but this might be a little better, as you can see here. So going back to the instance of what do you call them? Standard deviation. This is another way of looking at it. So you can see here, I'm assuming this is how it work. If you're staying in the blue region, you're still doing okay. Once you drop back below going into the red, that's your exit. So there's many different simple strategies you can build with something like a regression. And the thing I love about these indicators column, you let me just see here. You can get the source code right there. So that's all Pine script right there. So you could build in your automated points of entry and exit. We've got an indicator on how to do that um, as well on quantlabs.net, or sorry, quantlabsnet.com. So that's kind of like regression, a simpler way of looking at it. And you can see how it's very useful. Again, it depends on your platform, depends upon your indicators that you have available on the platform. But again, this is why I use TradingView, because it's simple and it's effective and it's just very intuitive. Okay, coming back to here. So we showed you the machine learning and the general regression. So let me go back to this. Actually, I showed you before. So the second one on the regression here from Lux Algo, uh, regression, which was, okay, so let me see here. So we have a linear regression here. Yeah, so that's what I want to show you. This one's probably a standard mathematical, no machine learning in it whatsoever. Okay. Whereas that automated one, I think that was a trend line, but let's just see if there's anything in here that might be quote unquote AI or machine learning. Um, so there's the histogram. Uh, Yeah, I don't think you'll find a lot of AI yet in TradingView. It's just kind of restricted the language, but generally, I think you can do without the machine learning. It might be just a buzzy word for third parties that might want to sell it. Last one we look at is calculus here. Again, these are the differential and integral calculus. I'm not going to get into that, but these may, uh, yeah. So as an example here, the speed of your price, that's when you start to see things go parabolic. So this will accelerate as the price moves up faster, and same on the downside as well. So there's different indicators you can use with the quote unquote simpler math on it. Anyway, so that's generally some of the different techniques put out by quantitative. But as I said, if you want to know more and kind of do it the simpler way, is do it this way. Go to quantlabsnet.com, go into learn. If you're curious about TradingView, I've got a 45-minute view there. I also going to be offering a free intro to our why use TradingView soon. So if you opt in for that, please do so. Thanks for watching.